The last 2 points are really where we're going to spend more time today. So products have come a long way. They've come along in leaps and bounds over the last 20 years. We have better medical aid than we've ever had. We've got better income protection and critical illness cover. And a lot of these things reduce a client's risk exposure, but they also reduce the need for large amounts of critical illness. We're going to touch on the evolution of medical aid, the evolution of critical illness. And it's very interesting because the advice process hasn't kept up with the developments in the product space. We don't take into consideration the fact that medical aid is a lot better than it was 20 years ago. We don't take into consideration the fact that critical illness was actually developed before medical aid. And when it was developed, it was there for a very different purpose. Yet the amounts of critical illness cover that we're recommending are very much the same as they were in the past. And then we're going to touch on this, this concept of life insurance, which was focused on death in the past, and it's now evolved into this kind of living insurance solution. Disabilities and critical illnesses are no longer death sentences, and I think we need to figure out how we find, the sweet spot in terms of using lump sum and income benefits to cater to this. To make sure that our insurance is relevant, not only in the event of stuff that's really, really serious, but also in the event of less severe, more likely events. And then just to zoom in on some of the kind of product trends and developments, medical aid and gap cover have improved significantly. I think, medical aid was invented or first rose to popularity in the early 1990s. Critical illness was invented before that, critical illness cover. And I think then it served a very different need. Medical technology has improved, as I've said, and there's all of this early diagnostic technology that's now being used. Critical illnesses are being caught a lot earlier on in the process. And that's kind of, I think we have to look at critical illness benefits through that lens, without this doomsday view that, clients are going to get stage 1, 2, 3, 4 cancer or suffer from a serious, heart attack or stroke. The reality is, cancers are a lot more likely to be caught at stage 0 these days. And then income protection, has grown massively popular in the last 5 years. I think led by FMI and some of the more niche revolutionary product providers, and everyone's followed suit. Income protection isn't only limited to professionals these days, as you all know. It's actually available to pretty much everyone. People with high risk occupations, even homemakers can now qualify for income protection. And I think this is a fundamental consideration when you consider critical illness cover. And how do we use income protection and lump sum critical illness in combination with one another to reduce our clients' risk exposure? So if you look at these three things, actually, the risk that our clients face today is lower than it's ever been before. Yes, cancer is on the rise because of obesity, but I also think it's on the rise because of diagnostic technology. But despite all of this, critical illness benefits are becoming more and more complicated and more expensive. And as a financial advisor, I feel for you all, because how do you compare? How do you prioritize? It's almost impossible unless you're a doctor and you spend all of your time comparing these definitions. So what we're trying to encourage today is, looking at critical illness advice or critical illness planning differently. And I speak to a lot of advisors who are so scared to sell anything but the best, and clients will pay. And I think that there's a different way to do things. I think that there's a middle road. There's certain trade-offs that can be made where, we can insure against the most likely risks and the most severe risks, but also make sure that our clients can keep their policies lean and mean and retire, comfortably and at the right age. So, I mean, I say that critical illnesses or critical illness cover has become extremely complex and comprehensive. And there's this war out there in the market around, the number of diseases that can be covered and all the bells and whistles. But I think there's also some really, really cool product developments out there that a lot of us are not aware of. And as Icon, being independent and having exposure to a lot of these benefits that you might not be aware of, I think it's important that we don't forget about them. I think that they play an important role in catering to specific niches in the critical illness space. And today you've got special benefits for females. So these, specifically cater to pregnancy complications or birth defects. Great for young females who want to start a family. You've got core and comprehensive options. As we know, the big four: stroke, cancer, coronary artery bypass, and heart attack cater for more than 80% of critical illness claims. And all of that is covered and wrapped up in those core benefits. And I think using those strategically with less comprehensive, with lower amounts of comprehensive critical illness cover can be the answer in some instances. You've got product providers who have these really awesome standalone cardiovascular and cancer benefits, which you can add to bolster your comprehensive critical illness cover. And this can open up really cool conversations with your clients. You can start to ask them, what are your fears? What are you most scared of? Do you have, a family history of cancer or cardiovascular issues? And we recommend opening up the conversation to make it broader than that. Are there any hereditary diseases that run in your family? Because we want to be there for you if you come across a client who does have a specific requirement or a specific concern. We want to be able to go and do that research and provide you with the most appropriate solution for them. Critical illness income, I think, is incredibly relevant at the moment. The needs associated with a critical illness, if you've got good income protection and good medical aid, you don't need that much lump sum cover. It should be there to cater for additional needs. Critical illness income, it really helps cater for those monthly needs associated with critical illnesses. Being able to take time off work to recuperate mentally and physically, being able to get a carer in the event that you need someone to look after your kids while you're undergoing treatment. And then all of the additional expenses, maybe with organic foods or natural medications. All of those are monthly expenses that can be catered to by an income benefit. And then lastly, childcare benefits. Obviously, very sadly, more and more kids are being diagnosed with critical illnesses these days. And a lot of these benefits are either ancillary or built into the products already. So I think when giving critical illness advice, it's just important that we don't default to the most comprehensive. Clients are really going to pay for that, especially in the volumes that we see it sold today. It's important that we start to consider some of these really cool, really relevant, but also really affordable options for our clients. So just taking that into consideration, we've got a risk guidance view that we've developed. And I think this is something that is unique to Icon, something that we're very proud of. And it's something that advisors have struggled a lot with in the past. What is the order of priorities when it comes to giving risk advice? When a trade-off needs to be made, what do I prioritize? And this has been done very well in the investment space. You've got the rise of discretionary fund managers that provide you with the investment advice process, the risk modeling, the due diligence. And I think that's simplified the lives of advisors massively. There's nothing like that on the risk space. And that's really what Icon is trying to achieve. So if I explain our macro view or our overview on building a financial plan, there's really three areas which we believe are important. And the first one is that cover should be tailored to the client's individual needs. I think in the past, because benefits were very simple, we'd do an FNA, it would say, I need 10 million Rand life cover. And within that 10 million Rand, there were provision for 3 or 4 different needs, whether it's estate duty, debt, dependents. I think that's no longer relevant. We can split those needs up to make sure that they're catered to in the most efficient way. Also, I raised it earlier around trying to understand what your clients' concerns are, what their worries are, and offer them a solution that specifically caters to those concerns as well as everything else. And that client wants to help you do. The second point, we believe that risk cover should make a client financially neutral. We believe in this very, very strongly. We've heard it so often how clients are, worth more dead than alive. And we don't believe that that is sound financial advice. I think clients, or a lot of clients, are paying a huge amount of money for risk cover and not enough for retirement provisions. And I'll take you through an example that I actually came across earlier this week that speaks to that point exactly. And then lastly, your risk is there to protect your retirement plan. I think in terms of the order of priorities, risk should come before investment because risk protects your balance sheet. In the event of an injury or illness, if you cannot, earn an income, you can't make contributions to your retirement. And whether it's severe or minor, these events have a drastic impact on our retirement savings. So just to sum it up, risk cover should put you in the same position, after as you were in before. We don't believe in overinsurance, and we believe in keeping the policies lean and mean, but most importantly, using those savings to fund retirement. And again, I'll take you through a case study at the end that speaks to that point. So once we've kind of covered those 3 overarching views or philosophies, what is the order of priorities? And I think, I speak to a lot of advisors and they say, Jono, very seldom do I do an FNA and it gives me, these values and a client can afford it. Almost never. So when we have to make trade-offs, what do we prioritize in covering first, second, third, and fourth? And we've done research on this, and we've got a view on this as well to help you and your clients make those decisions. And the first base to be covered, because it's just so holistic and also so likely from a risk perspective, is insuring against illness or injury. And this is done through income protection, temporary and permanent. And we encourage people to insure as much of their income as possible before they insure anything else. Before you make a trade-off on your income protection to purchase critical illness cover, we believe you should prioritize income protection 100%. Because in actual fact, it caters to so many critical illnesses that could arise. So once you've taken care of your income and you've insured it at 100%, then we start to look at your critical illness and your lump sum disability. Critical illness with a combination of the benefits that I've spoken to earlier. So critical illness income and critical illness lump sum, whether it's comprehensive or not. Once your critical illnesses are taken care of, then we can look at lump sum disability to cater for once-off needs or debt. I think so much debt, or all of your debt, is serviced through your income. So in actual fact, by making provision for 100% of your income with an income protector benefit, it reduces the need for lump sum disability. So the affordability trade-off, like I said, take as much income protection as you can afford, but keep it consistent across temporary and permanent. If you can only afford 50% of your income, don't insure 100% of your income for temporary and 50% for permanent. We ensure keeping it even across both events. Prioritize your medical aid first and your income protection first before putting critical illness protection in place. medical aid and gap cover and income protection will cater for 90% of your critical illness needs. Very often we see people prioritizing critical illness cover and the client doesn't even have medical aid or income protection. And then once you've got these bases covered, only use death cover in the event of dependence, very importantly, and only sometimes if you have debt. So for things like estate liquidity, there's great benefits on the income protection side that will pay an income, for 1 or 2 years while your estate's being wound up. Death expenses, one-off needs like funeral and estate duty, obviously lump sum is the way to go. And in terms of providing for dependents, life income is just so much more appropriate in terms of cost, but it also mitigates all of the behavioral risks associated with lump sum cover. It's incredibly powerful how, when we show you later on, a combination of income and lump sum benefits, the way it changes not only the initial premium, but the savings on that policy over the lifetime of the policy. And lastly, I just want to reinforce this message. Insurance shouldn't be there to leave a legacy or an inheritance. We believe that you should be worth, the same dead or alive, but use those savings instead to fund your retirement. The likelihood of you retiring at some point in your life is a lot greater than the chance of you dying young or, catching a critical illness. So I'm just going to hand over to Sam now. She's going to run you through some of the questions or points that our advisors raised, and we'll just be explaining our thinking on those.
Cool, thanks, Jono. So I had the fun part of answering all your questions, and I wanted to start back by going a bit back in history. So critical illness was originally invented in 1983, and this was not by an insurance company, but by Mr. Dr. Marius Barnard. And he's a heart surgeon who was part of the team that performed the first human-to-human heart transplants in South Africa. Most of you know Christian Barnard, and this is his brother. So he started to see a need emerge where his patients were experiencing financial difficulty after surviving heart surgery or other life-changing surgeries. And he described this as clients living for years but being dead financially, and the impact that this had on their income. So this is basically how critical illness was born. And back then we didn't have income protection, medical aid wasn't even a thing. And so the most appropriate product at that point in time was critical illness. But now with all the product advancements that Jono has been talking about, you can cover 100% of your income, and you're able to cover your illness, injuries that would affect your ability to earn an income on a daily basis. And then all that you'd need at the end was this additional small amount of critical illness, either to boost your lump sum or to boost your income, to cover those additional costs, such as household, maybe you want a wig, maybe you need a home adjustment, those rehabilitation sessions that your medical aid may not cover, a carer to look after the kids, Uber costs, counseling, the list can go on. All these small costs that were unexpected. So if you've covered your base and everything else is in place, and you've put enough money towards your retirement savings, the question is, how much do you really need? The next question that we had was, how do I avoid risk advice if a client is diagnosed with a rare condition not covered by their critical illness policy, but covered by another provider? So for this question, we actually wanted to pose a question back in response. How do you avoid advice risk if a client puts most of their money into risk products and not enough money into the retirement savings, and they end up outliving their money? If you can't even afford to pay for critical illness post-retirement, then does this question even matter? People are living longer. We need to look at how to compromise and prioritize cover to mitigate the risk of running out of the money and ultimately not being able to afford anything. And this really forms part of the record of advice, and your RAA is the only thing really protecting you. And it's important to note these type of reasons and back them up with research, which is what we're here to do at ICON, is to assist you with this. So let's look at the next one. There's so many providers with different strengths when it comes to their critical illness cover. How do we prioritize? How do we cut through all the noise? as Jono mentioned, there's so many product innovations coming out of South Africa. When we look at it, 46% of product innovation in the insurance industry, with a study done by Munich Re in 2017, comes out of South Africa, but not much innovation in the way in which this is delivered to the end consumer. And that's where we believe, as a distribution force, we need to step in and assist you in looking at things a bit differently to catch up with the times. So we believe by prioritizing what is important to the client and really listening to their concerns. What is their family history? Are you really able to use product innovation more fruitfully and deliver a bespoke solution through asking these questions? And the answer is yes, you can. And this way, you're able to really look at a client's current circumstance and their future potential circumstances through these questions. And then instead of exhausting this list of conditions that all these companies are providing, you're able to narrow this down to more claimable events and more suitable products for your specific client. And then John is going to give an example of some of those products in his quote. And the final thing I want to end off with is what is actually important. After you've prioritized the client's unique circumstances, then what type of factors are actually important when selecting critical illness? I mean, do I pay attention to the number of conditions? This company covers 200, this company covers 120, 300 plus. Is that important? Or are survival periods important? Or is having that one rare disease that company A covers that company B doesn't cover? Is that key? When we look at the stats, 10 to 25% of claims are made up of less likely, lower severity claims, where the big four that Jono mentioned, the SkyDeps, account for the largest percentage of these actual claims. Most companies cover the same conditions. The numbering of the conditions is largely a marketing tactic, and that's where we need to question what these marketing tactics are doing and what they're trying to convince you of in order for you to buy their product. So let's have a look at this example here. So we have company A, where we're looking at stage 4 cancer, level A, and company A is listing 12 conditions for this specific event, whereas company B is only listing 1. Cancer, level A, stage 4. So they've only got 1 condition. But they're basically saying the same thing, but they're telling you that they're covering more conditions than company B. So these are the type of things we need to look at. Is the company that has the most conditions necessarily the most appropriate, or do we need to dig a little deeper? And John is going to take you through that now.
Cool. So I think this slide is irrelevant at this stage. We've said it so many times. The big four cater to 75 to 90% of all of your claims in the market. And to my point a little bit earlier, these are being diagnosed earlier and earlier. So how do we know which company covers the big four conditions the best? The truth here, unfortunately, is that it's a very, very difficult question to answer. Most doctors can't even answer this question just because everything is so nuanced. There's so many complexities. One company, might be the best at early stage cancers, where the other company is the best at cardiovascular. One might cover, coronary artery bypass the best, and another might cover strokes the best. So again, it's all about understanding what's important to your clients, but making sure that there aren't any booby traps along the way. And I'll just highlight 3 or 4 things that I believe are the most important to consider and look out for when you're comparing the big four. So this is just early stage cancers. Cancers being diagnosed earlier and earlier. We've said it, a ton of times in this session. What's very important to us as well is not just how the SkyDep conditions are being assessed, but how is early cancer being assessed? It's being caught more often than not before stage 1 even happens. Before stage 1 even happens. I think Sam mentioned it earlier, how 25% of breast cancer is being caught at stage 0, and more than 30% of prostate cancer is being caught before stage 0. And over the last 5 years, cancer made up for 60% of severe illness claims. So cancer is really, the the most important thing that we've got to look at when we're comparing critical illnesses. And what's important when we are, comparing. And I think these four are the most important things to look at. So comprehensive early cancer benefits should be your top priority. And a lot of companies do this very well. A lot of companies don't. So the most important thing to look at is when they say they've got an early cancer benefit, is there an exhaustive list of early stage cancers where they've mentioned them one by one? Or is there an all-encompassing clause for all early stage cancers? And I'll show you an example of what that looks like. We need to look at optimal treatment requirements. So optimal treatment is a very gray area. This often results in delayed claims or claims not being paid out at all, clients having to jump through hoops and undergo treatment that isn't always necessary. And then lastly, we need to look at Gleason scores. So a lot of early stage cancers and more developed cancers, there's a Gleason score requirement attached to that. So with SkyDep, anything below a Gleason score of 7 doesn't even apply. And that's when early stage cancers would come into the conversation. So this is just a snippet of an exhaustive list, but also an exclusion around Gleason score. So they've specifically mentioned prostate cancer, and it'll pay out unless any tumor of the prostate, unless histologically classified as having a Gleason score greater than 7. So this means it's not an early stage cancer benefit. There's a Gleason score requirement attached to that. At the bottom of this slide, I've taken two good examples of a non-exhaustive list without any Gleason score requirements. So the first is any lesions histologically confirmed to be a carcinoma in situ. Simple, there's no kind of measurement or diagnosis requirement attached to that. The other is a catch-all carcinoma in situ of any other internal organ or bodily structure. So those are really the types of definitions that you want to look for when you're comparing early stage cancers. Guys, if there's any questions up until now, please just pop them in the Q&A box and we'll try and get to them. I know we're running slightly over time, but I'm going to wrap things up now. So these are really the things that we believe are important to consider when you're looking at definitions, when you're comparing cancer benefits, and when you're analyzing SCEDIP conditions between the different companies. But I'm going to take you through a real live example of what we believe is appropriate advice for a client using what we've spoken about today. And this is a real scenario that I came across on Monday this week. It was a 38-year-old male who was a CA. He was earning 75,000 Rand a month. And this guy, I was quite shocked to see he actually had more than 5 million Rand lump sum critical illness cover. He had 5.5 million. And he was paying roughly 10% of his after-tax salary for his risk cover. He didn't have full permanent income protection. He had lump sum disability instead, which, as we know, is extremely difficult to claim on. And he had no life cover because he actually didn't have any dependents. So this guy was paying 4,250 Rand for his risk benefits, okay? And that's all well and good at this point in time. This guy's young though. So in 15 years, when he's 53, what is that premium going to look like? In 23 years' time, or in 25 years' time, when he's almost ready for retirement, and when he's at the highest risk of claiming on a critical illness, what is his premium going to look like then? And I'll show you that. So structuring benefits like this it's great in terms of, your client thinks they're going to have this huge lump sum payout if they get stage 1 cancer, which I don't think is appropriate. But the realistic view on this is, when a client gets older and they're at the highest risk of having cancer, probably in their 60s or 70s, I can guarantee you this guy's not going to have all of his critical illness cover in place, because he's either going to have reduced it or canceled it entirely, because he's not going to be able to afford that premium. Instead, using the ICON view, and this is again where our objective risk guidance comes in, we would restructure that policy entirely. So first priority, like we said, is income protection, making sure that you're insured at 100% across both your temporary and permanent income protection. The present value of that permanent income protection is over 11 million rand. So because of that, we've been able to reduce his lump sum disability from 5 to 1 million. That 1 million is probably also quite generous, there to take care of a small amount of debt and any once-off expenses. So the 5 million lump sum critical illness cover, we've challenged the advisor on this view, and we've said, reduce that to 500,000 rand. Make sure that he's got comprehensive medical aid instead, but take out a critical illness income benefit, which is far more appropriate for the needs associated with a critical illness claim. And this client was particularly concerned about cancer because his father had had prostate cancer. So we recommended taking out a 1 million rand cancer benefit, which cost 95 rand a month. The financial impact of this change was huge. So initially we managed to reduce his premium by about 75%, but because we used a combination of income and lump sum benefits, the future premiums were significantly impacted. So in year 5, the client was paying under 2,000 rand where he would have been paying over 6 grand. By year 15, we're saving the client 14,000 rand a month. And at this stage, the client's going to be 53, still relatively young, very unlikely that he would have had any critical illness claims. Fast forward another 10 years, which is past the premium projections on the quote, and you can only imagine how these premiums ramp up exponentially. This graph just shows you that huge gap between the two different approaches. And again, this is where making the trade-off really matters. This is where the advice process comes in. And this is, how we can help clients retire comfortably. So we did some bush maths and calculated, if we were to invest the premium savings every single month at an assumed return of 10% per annum, the nominal saving is 1.2 million rand, but the retirement boost after 15 years is more than 2.5 million. So that's before the clients even reach retirement age. Extend that for another 10 years, and the savings become even greater. These are the conversations that we need to start having with our clients, where trade-offs can be made, and we can still cover all of the risk without having this view of enrichment or taking a bit of a gamble. If you get stage 1 cancer or you have a stroke, you're going to get this massive payout. I think we need to start betting on reality, and actually start saving our clients money from day one. So I think if we can leave you with 2 or 3 points, what we really wanted to challenge in this session today is that we just need to start rethinking the way critical illness cover planning is done, taking into consideration developments in medical aid, gap cover, and income protection, and really starting to cover our clients for the important stuff, but not over-insuring them. So we believe the order of priorities should be medical aid, then income protection, then critical illness. Prioritize covering those big 4 conditions first and well. And lastly, have that conversation with your client. We know the prospect of critical illness is a scary one, but I think the prospect of never being able to retire, or being able to retire below your means, or being dependent on your children is even scarier than that prospect.